let's talk about option Greeks. Yeah, so there's nothing complicated about this. This is just using Greek letters to represent some metrics. So when you hear option Greeks, what we are talking about is different types of metrics. So these are just metrics. Yeah, and they are actually used to describe how option prices change when some factors are also changing. So let me put it this way, these are metrics used to describe or quantify how option prices change in response to change in other factor. Remember, the focus is how option prices change also when other things are also changing. So, which means what we're talking about here is how are the option values changing when different things are changing. Different things can be anything. An example is the price of the underlying. So what is going on is these metrics are various types of metrics. Yeah, different. And they are being represented by Greek letters. So these are represented by Greek letters. So the Greek letters doesn't mean that the whole concept is complicated. It's just a letter. The same way you have A, B, C, D. So you have alpha, beta, and all of that. But what are those metrics? What are the Greek letters that are being used here? The first one is delta. Yeah. We have gamma. There are a lot of them. However, I'm only focusing on what you need for this paper and theta. We have rho and all of that. But I'm just going to focus on these three for you. Yeah. Because I know this is a relatively new concept for you, and I'm not going to give you just too much information that are not useful. Yeah, so let's focus on these three, and I will start with delta. Yeah, I'm sure what we always know is that delta is a change, Gamma is also a change. Theta is also a change, interestingly. But just that the type of change is different. So for delta just measures how much option is changing when the price of the underlying is changing. So delta is just changing option price, option value, relative to change in underlying price. Simple. That is delta. So delta is asking when the underlying asset price is changing, how much change is the option value experiencing? That is what delta is measuring. And why is it useful? It's very useful in risk management. So usefulness is in risk management because there's a way you can use your data information to construct what we call delta edge. Remember, risk management is edging, risk reduction. When you construct delta edge, what you have is a situation whereby you cannot make loss. No loss, although you cannot also make profit. No loss, no profit. And how do you construct this kind of portfolio? How? We're saying what you need to do is to ensure that, please, this formula is very important because this is your edging formula that you must always use to achieve delta edging. So to have that, your portfolio, the number of assets in your portfolio, take for instance, let's use shares for example. e.g. shares, must be equals to your delta figure multiply your delta figure by the number of call options that you have sold. Multiply by the number of call sold. Remember, you must sell a call, not a put. You don't use put for delta edge. You are selling a call and you are not buying the call. What you are buying is the shares. That is your portfolio that you have. So please note, they are opposite position. This is a long position and this is a short position. So which means your asset must always be equals to the proportion of your option that you have shorted. Okay? And that gives you a perfect edge. And you can check it. Let's do an example to just see what we're talking about. Let's assume you have a portfolio of, say you have a portfolio. Let's construct a portfolio, an hypothetical portfolio. And this portfolio has, let's say, 100 shares, So 100 shares. And these 100 shares, we have a delta of 0.5. If we have this portfolio, and delta on call is 0.5. To construct perfect edge, we need to calculate the number of call to sell. So which means 100 shares is equal to 0.5 times call. So it means we need number of call that is equal to 100 over 0.5, and that is equal to 200. So which means we must sell 200 units of call option to achieve a perfect edge. 200 units of call option. So sell. Once we sell this, then we're going to have a perfect edge. So this needs 200 units of call. In a short position. And think about it. Let's say after the next day, the share price becomes $2. And when we had this portfolio, let's say the price was $3. Look at it. Now, the share price has changed. So change in share price is already 2 minus 3, which is equals to minus 1. So that looks like a loss position because we have 100 shares times 100. It means we must have had minus 100 if we did not have an option position. But because we've done a perfect edge of delta edge, you will see that this loss will be taken care of by the short position that we have in call. So which means we need to find out what has happened to the valuation of the call. But we know that our delta is equals to change in selling price divided by change in option price divided by change in selling price. Remember delta, option value divided by change in underlying price. So which means that the change in our option price is equals to delta times change in selling price. So which equals to 0. We said delta is 0.5. So that's 0.5 times change in selling price. Change in selling price is minus 1. So that means our change in option value is equals to minus 0.5. So that option has lost value by minus 0.5 per option. So which means the total value loss on that option is equals to minus 0.5 times we sold 200 units. Remember, 200 units to achieve our perfect delta edge. So which means that the total loss of value is minus 100. But remember, all the calculations are always done from the buyer's perspective. So if a buyer is crying that the value of my option has gone down by minus 100, it means for seller the value has gone up. Because this is from buyer's perspective. This is buyer's view always. So the opposite will be for the seller. So the value must have gone up by 100. So it is positive 100 for the person that sold it. So which means we sold it. We took a short position. So as the selling price has gone up by minus 1 and our share is losing total of minus 100, the option is gaining 100. And that is why the portfolio will have zero impact. So we have not lost money. You can play around it. You can even increase it. If you increase the selling price, as you are making profit from the shares, the option value will also be coming down for you as a seller, because for a buyer the option value will go up, and you see that eventually it's still going to give you zero impact because you've got a perfect edge. That is how data edge works. But remember, the reality is that the next day we are talking about that the selling price has gone to 2. Most likely the delta will have changed, because we have already said that delta changes because the share price will always change. So when the share price is changing, the option value will be changing, and likewise the delta most likely will be changing. And because the delta is changing, so what I'm saying is that delta, remember your delta edging position that you are constructing uses delta information, right? And we know that delta depends on changes in underlying selling price. So which means when underlying selling price is changing, which will always happen because the selling price of underlying will always change. So I'm building a scenario for you, will always change. And you agree with me? Yeah, all these things will always happen. So which means if the selling price of the line will always change, delta will always change. Yeah. Let me write it, because using the symbol might now be confusing. So let me just put delta. Delta will always change. And what does that mean for us? It means that our edge position will have to be updated. So therefore, edge position will always have to be updated in order to reflect the new delta figure. Because remember, you need to use your delta to edge. This is your delta that you have been using to edge, that determines the number of shares and the number of costs. So if this figure is changing, you need to change this so that this multiplication equation is still balanced. So to reflect new delta. So this process is what you call dynamic edging, because you always have to update based on the changes in the market. So this is called your dynamic delta edging. And that is why edging with this delta method can be a bit tedious. Yeah. I mean, take for instance, with that example that I gave you now, if when the price, assuming that when the price changes from 3 to 2, yeah, we said we bought it at 3. Now it has changed to 2. Let's assume that the data also changes. So if data becomes maybe something different, let's say data that used to be 0.5 all of a sudden became 0.7. It means that we need to reconstruct our portfolio. we need to rebalance. So this can be called rebalancing. Yeah, we need to rebalance our portfolio. And how do we do that? We need to focus on our asset. We don't touch our option contract. Leave the option contract. We'll either buy more asset or sell some of our asset to balance our portfolio. What we know for sure is that currently our portfolio is this. So currently we have 200 short call and 100 long shares. That was the edge balance portfolio that we had before this one, before the share price moved. And when the share price moved, the delta changed. So these shares, we bought it at $3. Now the new price goes to $2, and the delta that used to be 0.5 has now become 0.7. So as it is, this portfolio is no more edged, and we need to update it. We need to rebalance it. So how do we rebalance it? What we know for sure is that our portfolio asset, which means the long asset, the number of long assets, remember that formula must be equals to the delta multiplied by the number of short calls. So we know our short calls is 200. The delta has changed, is now 0.7. So which means the number of long assets that we have must be 140 units. And in that case, to balance our portfolio, to react to the change in delta, we need to buy 40 units of shares. And once we do that, we're going to have a balanced portfolio. Because as we have, this portfolio is not balanced because delta is no more 0.5, 0.7. So if you do 0.7 times 200, that is 140. So 100 is what we currently have. 100 is not equals to 140. So we need to buy 40 more so that we have 140 shares equal to 0.7 times 200. And that's how you rebalance. And that is what delta is used for. So delta just helps you to prevent loss. Delta edge, helps you to prevent loss. But delta gives the information you need to be able to construct the delta edge. And that is it with delta. Now, the other two that I'm going to touch on are much easier because I'm not going to be doing any calculation on them. And that is talking about gamma. Yeah. Gamma is a bigger brother of delta because it measures actually the rate of change in delta when the underlying asset price is changing. So this one measures rate of change of delta in response to change in selling price of underlying. Because we already know that when the selling price of the underlying is changing, delta will change. But the question is, how big is the change? Change in delta over change in the selling price of the underlying. So, and why do we need that information? We need that information because if the delta is very high, it means that with a small change in selling price of the instrument, the delta is changing so much. The option value will also be changing so much. And that means if delta is changing very frequently, then we need to rebalance frequently. And in summary, what we're saying is that this will tell us how easy risk management will be for our portfolio. So this measures how easy, that is how frequent or infrequent we need to do rebalancing. So how easy risk management. will be. That is what, because if gamma is high, then you need to rebalance your portfolio many times, frequently, because for a very little change in price of the underlying, delta is changing, and once delta is changing, you need to keep reconstructing your portfolio. So that's why gamma is important. It helps you to see how easy your portfolio will be, how practicable it will be. Now, theta. Theta is slightly different. This one is a time measure metrics. And what does this tell you? Remember, I said your option value comes from two sources: intrinsic value and time value. Time value is where theta is important, because for option, remember, we're talking about you being able to discount back from the expiry to today. So which means this is the point where your time value will be the highest. And as you get closer to the expiry date, your time value will decrease. And at this point, your time value is 0. Because on expiry, there is nothing to discount again. There is no benefit from that time value again. There's nothing to talk about, because we're talking now, the future has become present value. So it's now 0. There's no extra value from the time. There's no risk because there's a delay or time involved. No. So what theta measure is how fast that time value is going down. And that is why it is called a decay matrix, time decay matrix. So this measures how option time value, let me put it like that, not intrinsic value, the time value, how it is lost over time as the option approaches expiry. Because, like I said, at expiry, in fact, let me just note it down for you. Because at expiry of option value is just equals to the intrinsic value. There's no more time value involved again. We are already at the expiry date. So, and what is the use? It helps you to measure the value decay. Yeah, that the value you will lose per day as your option is getting closer to expiry. So you can decide whether you want to quickly sell or not. So like I said, the use is that this one will measure time value decay. That is the value lost per day. Let me put it like that. Value lost per day. Yeah, very important. So those are the option Greeks, and very important to be comfortable to be able to explain them, especially for delta. You'll be able to do some calculations on it.